Good afternoon, everyone.
Good
I
afternoon.
see a, Mang- I see a Mangesh Kindre, Chairman Valuation Standard Board of ICI. Welcome you all to this webinar on valuation of inventory accounting vis-a-vis valuation aspects. I also welcome with me CA Pramod Jain, my Central Council colleague, who is going to take the accounting aspect, and CA TV Balasubramaniam sir, who is going to take the valuation aspects today of the inventory. To tell you very briefly, Mr. Pramod Jain is a chartered accountant and is a Central Council member. He is also chairman of Accounting Standard Board and Expert Advisory Committee of the Institute of Chartered Accountants of India. CATV Balasubramaniam sir is a registered valuer and well-known chartered accountant for more than 30 years of experience in valuation and financial consultancy. Let me also welcome the Vice Chairman of Valuation Standard Board, CA Kota Srinivas from Bangalore, and CA Abhay Chajed, Vice Chairman of Accounting Standard Board, attending this meeting from Bhopal. I welcome you all, friends. Now, we are having this meeting specifically designed for this much awaited or much sought after topic. I would like to mention here that the introduction of the and subsequent adoption of Indes by many of the Indian companies has increased the emphasis on valuation significantly over last decade. Now, fairly presenting the values of the assets and liabilities lies at the heart of the reliable financial reporting. With increasing mergers, acquisitions, buyouts, and insolvency proceedings in the economy, the importance of valuation has started increasing more in today's financial world. But still, uniformity or standardization is much sought after. Now, therefore, this standardization or uniformity is much concerned today. And recognizing this need, the Institute of Chartered Accountants of India has come out with the valuation standard in 2018. You may be knowing that perhaps in India, it's only the Institute of Chartered Accountants of India has its own valuation standards. ICI valuation standards have been made applicable by ICI for all the valuations which are covered under Companies Act 2013 for its members, whereas for other laws, it is being recommendatory in nature. Though we can make the valuation process more codified, scientific, however, valuation will still always remain the decision or based on judgments or subjectiveness. Friends, valuation is very serious area as this is lying in the heart of the entire process of mergers and acquisition. While the valuation rules have put the onus on valuers in terms of increased liability and responsibility, the valuation standards as issued by ICI and adopted by ICI, the registered valuers organizations, have the various positive aspects. Now, there's a consistency in the valuation, standardization in evaluation, then there are the best practices, then also certain cases which have been already discussed on valuations. So various other aspects, the registered valuers who are adopting the ICI valuation standards, they have an edge in evaluation, so to say. The field of valuation is witnessing the revolution, and the conduct of valuations by quality professionals will improve the public confidence. So these valuation standards of ICI are very important in this respect also. Now, today we are going to tackle this issue of valuation of inventory. The inventory valuation, we know we have Indes 2 on inventories, whereas Accounting Standard 2 on valuation of inventories. These are certain prescribed norms of valuation of inventory, cost or net realizable value, and so on and so forth. So basically, fair value of inventory is another key aspect, which perhaps many of us, dabble in exactly finding the fair value. Book value and fair value, definitely we feel that it's the same, but there are so many differences in this. While book value, there can be a static value, whereas a fair value goes on increasing or decreasing as the inventory goes on in a value chain. Considering this meeting has been organized because of accounting aspects at one hand, whereas the valuation of inventories at one hand may create perhaps a conflict also within them. So how to tackle it, how to tackle these issues, both in accounting as well as valuation, and how to have what you can say, a consolidated view which will really have a reliability in a financial reporting. That I think we'll have to understand today. We welcome all your questions. We have two eminent faculties, one who is heading an accounting standard board in ICAI and one who is actually practicing in this valuation area for a number of years. So I think today we are going to have a complete feast of knowledge as far as this aspect is concerned, and many of the difficulties, intricacies in our mind, I think we'll be able to get us answers to it. We'll definitely take some questions at the end, and we will begin with this session. Before that, my Vice Chairman of Valuation Standard Board, Mr. Kota S. Srinivas, is with us. I would be requesting him to express his views in the beginning, and then we will start with Mr. Pramod Jain on the accounting aspects of inventory. Over to you, Kotaji.
Thank you, sir. Thank you, Chairman, C. Mangesh Kinaria, sir. Also, we have with us the Chairman and Vice Chairman of the Standards Board, Pramod Kumar Jain, who is one of the speakers today, and also Abhay Chajet, the Vice Chairman. And the other speaker of the day, Bala Subramaniam, is also with us, a good friend of mine, and other officers and the secretary of this particular committee. As already explained by the chairman, I may not have much to add to that. So, few things which I would like to add on that is, as I said, we have RVOs. I think that we have around 16 RVOs in India, and ICA is one of the RVO, and only ICA has brought in all these standards. The other RVOs are not brought in any standards. A few of them will use the ICA standards, and few of them will use the international standards. So ICA has taken a lead and is a pioneer in bringing out this valuation standard, which will help the members, and we are eager to spread the standards that has been set up by the ICA, not only to the RBOs in India, but also abroad. So in this perspective, institute, our board or our committee is organizing various programs, and that has been shared with all the branches of India. So if any branch is willing to organize a program, we can do that, because we can't do the certification course. The ICA RVO only can do the certification course. We can do something, a preliminary course or a curtain raiser, or to get you a basic understanding of valuations. And as our chairman said, inventory, accounting versus valuation. Accounting will happen in the regular course of finalization of the accounts. This valuation comes only on certain important occasions. Like he said, there may be mergers, demergers, selling or buying of organizations. So now it's a trend of having this fair market valuation. And when once we see the assets, even if you see the AS28 where we talk about impairment of assets, we usually go and do that. What is the realizable value or net realizable value or fair value of asset on a particular day? That we will do in the accounting standards 28. But we don't have fair valuation of inventory doing the balance sheet or finalizing the balance sheet. These things comes only when once you have to have a different type of transactions assets. And inventory is a very important item in the balance sheet as such. If you are, all of us are aware of that. If you take the current assets of a particular balance sheet, maybe it may be the highest value, maybe inventory, or the second or third highest value will be inventory. And for accounting, we have various methodology, like as you said, the cost of net realizable value, or even we may use weighted average or something like that. But when once it comes for valuation, the fair market valuation rules and what all the methods that you have to be used will be dealt in the next few hours. So I wish that all the participants who are participating in this particular program will be enlightened at the end of the session with both accounting of inventories and also valuation of inventories, which takes place at certain events. That is like mergers, demergers, liquidation, insolvency, etc. So that's how we are organizing this particular program, and we would be interested to organize many such programs. Maybe at the end of the session, or you can just write back to us what all the other areas you would like to have sessions. And our committee, under the leadership of Mr. Mangesh Kinaria, we will be having a lot of sessions, and all the members will be benefited out of that. So I once again thank the chairman for giving me this opportunity. I wish a happy learning for this particular session. Thank you.
Thank you, Kotaji. Friends, before we begin, I would also like to tell all that we have published the concept paper on inventory valuation after such seminars last time we had. We would definitely like to have few more such publications, and it all depends on the interest of the shown by members. And as your questions come, if we can just collate that and we can bring out one consolidated publication or concept paper on such matter, we would be definitely interested. The Secretary of Valuation Standard Board, say Sarika Singalji, is very much eager to do all these activities. So I request you all to pose your queries and to have an interactive session, although it's a virtual session. Let's have an interactive session and build up this repository of knowledge as far as valuation is concerned much more collectively. So now I would request Pramod Jainji to begin with his talk regarding the accounting aspects of the valuation. Over to you, Pramodji.
Thank you very much, Mangesh sir. Honorable Chairman of the Valuation Standards Board, Mangesh Kinare sir, Vice Chairman of the Valuation Standards Board, Srinivas Kothaji, Vice Chairman of the Accounting Standards Board, Abhay Chajetji, our speaker for the day, TV Balasubramanianji. We also are having our two secretaries of the boards, both the boards, I would say Accounting Standard Board, Parminder Kaurji and CA Parminder Kaur, and Valuation Standard Board, CA Sarika Singhal. And I congratulate ASB and VSB both for having this program basically on accounting and valuation aspects of inventories. So let us talk about the topic straightforward, and I'll be sharing a presentation.
Just 5 minutes.
Okay, fine. So let us talk about the accounting aspects of the inventories. And the first place I would say where the accounting and valuation comes is at the time, not it is during the operations of an entity, where in case they have taken any loan from any bankers, so they submit their statements to the bankers. And now everyone knows that in the case of companies, the amendment has been made in Schedule 3, that in case the company has borrowed certain amounts from the financial institutions and bankers, and the statements which they are giving for that working capital finance, which are for the working capital limits. So if there are inventories or debtors into that, so that inventories are telling with the books of accounts or not. So that is to be given in the Schedule 3 in the notes to the accounts. And also the auditor has to report in the CARO thereof. So both in Schedule 3 as well as in CARO, the reporting is there for the inventories. If I talk about CARO, again, inventories, there is a whole clause where we have to report. And if there is a variation, which is material, between the entries in the books of accounts and the statement which are given to the bankers, that has to also to be explained in the notes to accounts as well as the CARO. So that is the importance which from this year, the emphasis has been given on the inventories and what has been submitted to the bankers. So, and then comes the valuation for the first time when it is done. It is at the end of any reporting period where the financial statements are prepared, where the inventories has to be valued as per the relevant accounting standards. So let us see what are those accounting standards if I talk about. So those standards if I talk about, yes, as told by our VSB chairman, Ind AS, there that Ind AS 2 is there, and that is titled as inventories. That doesn't talk about valuation in inventories, but they talks that the title itself is inventories, but which includes the valuation thereof also. But it also talks about accounting concepts. For the other than Ind AS, that is Companies Accounting Rules 2021, as well as the accounting standard issued by ICI. Both have the AS2, which is valuation of inventories. But friends, there is another standard which is for computation of income and disclosure. That is as per the income tax CBDT, I would say section 145A, that is ICDS. And there also this ICDS 2 is there for valuation of inventories. So let us understand, so what each standard says. We'll not go in detail. I'll not go in detail. Of course, our speaker, TV Balasubramanianji, would be going into that. But let us talk about what the basic things about the accounting aspects thereof. If I talk about the inventories classification, sometimes we have seen that in the case of non-corporates, proprietorship partnerships, in the balance sheet side, we have seen inventories, they say, as valued and certified by the proprietor or partner. And they say just closing stock or inventories. That is not correct. The whole classification has to be given. And that classification has to be as per AS2. I'll not say Ind AS2, I'll say AS2, because Ind AS2 talks about something different. So AS2 talks about that it has to be raw material and components, work in progress, finished goods, stock in trade, which is in relation to the trading goods, stores and spares, loose tools and others. If then there is other, then you have to specify the nature. If you go to Schedule 3, that does not talk about and components. So it talks about raw materials, work in progress. So if you see the companies, you will see the classification, not in, even in the case of Ind AS 2, you'll see that the classification is done as per Schedule 3, which is required as per this requirement of, I would say, raw materials, work in progress, and all these things. So it has to be like this. Kindly see the same classification is required as per my ICDS 2 also. So same AS2 and Schedule 3 and ICDS 2. So any financial statement which you prepare, that inventories has to be classified into these separately. We have seen several times in the FRRB also, QRB also, that where in case the goods are being traded, they are still referred to as finished goods or raw materials. They have to be referred as stock in trade. I'll request the other speakers to keep themselves on mute, right? So it has to be stock in trade. That change has been done even in the AS2 in 2016. So I have to be very careful out there. And I have to do accordingly. So one thing is the classification has to be appropriate, and disclosure has to be made in the financial statement, in the balance sheet, that how the inventories are classified. Now, talking about valuation. Now, this comes again, I would say, I'll not go into deep what is, how it is to be valued, that TV sir would be taking care of. But I'm talking about a very, very basic thing, that how do we value? If we talk about method of valuation, which we give in the significant accounting policies also. So there, what we give is cost or market price, whichever is lower. Cost or market price, whichever is less, which is not correct. Or sometimes we say, no, it is not market price, it is net realizable value. So we write lower of cost or net realizable value. Again, this is also not correct. So what is correct? Correct is either lower of cost and net realizable value. And secondly, cost or NRV, whichever is lower. So a bit of grammatical English, I would say. But again, this makes a lot of difference. Now here, what is important in my view, that when you are finalizing a financial statement and later on auditing it, you are seeing that it is being finalized and then you are auditing it. So during the audit procedure, how you have valued it, what document do you have? Where you are saying that, yes, my Ind AS2 or AS2 has been properly complied with, and the valuation which you have in your hand, a copy thereof, contains the evaluation of valuing the stocks at lower of cost and net realizable value. So that chart, does it have the cost of the relevant items of the raw material, finished goods, WIP, whatever it may be, and its net realizable value, and then you compare. We have seen several places that it is just done on cost, and we always feel that net realizable value is selling price, which would be always higher. It is not so. It could be less also, but even if we say it is higher, but where the auditor is saying that it is lower of cost and net realizable value, what document is in his possession to conclude that it is lower of cost? Where was the comparison done by the management where the auditor has relied upon? So that document you please try and have in your audit file. I'm talking from though I'm talking from the accounting standards board, but I'm mixing because the overall picture in my view should be there. So yes, have this proper method evaluation and give it for all items. Raw material, WIP, finished goods, stock in trade, it could be different. So where then, of course, when you say it is cost, when you compare cost and net realizable value, there is a difference between net realizable value, selling price, fair value. We all know that net realizable value, it has been defined under Ind AS 2 also, that net realizable value is the selling price less the cost to complete and then cost to make the sale. So that is defined out there in Ind AS 2 as well as AS 2, I would say. So measurement of cost here could be a standard cost or it could be a retail method. This is provided in both Ind AS 2 as well as AS 2 as well as ICDS 2, all the three. And retail method cannot be used. See, retail method, you say the total selling price less the gross percentage. So that cannot be used anywhere. That can be used only in the case where there are multiple items, retail departments are there, only there it can be used. What I'm talking to you is very important in the various, I would say, smaller towns also, or in the bigger towns also, where there is an old practice in the case of, I would say, non-corporates to value at retail method, even though it is a manufacturing concern. So one has to be very careful. So which measurement of cost you can take. And then if I talk about cost formula, again, what is allowed under all the three standards? Ind AS 2, AS 2 as well as ICDS 2 is the most preferred one is specific identification of cost. So what is that item? What was its actual cost? If you're able to ascertain, do that. And if not, then you have got two formulas which you can use. One is, I would say, FIFO, first in, first out. LIFO is not allowed. We have been discussing through various years when we were discussing some places. So certain persons were following LIFO. It is not allowed, please. It is FIFO since past many years. And of course, the weighted average cost. No other cost formula is allowed unless you have a specific reason thereof. So valuation has to be according to that. Now, there could be, I'm talking about now certain aspects which could come in, which is not given, I would say, in any accounting standard, but they are there from a normal business practice, where there is a change in inventory, say due to loss of inventory, which is due to fire, due to theft. How to account for? Accounting standard per se doesn't provide that. Though there is, after Ind AS 2, there is some guidance out there. We'll be talking about that. But per se, it is not there. So what to do? Suppose there is a fire, there is a theft. And let us take a simple case. I'm not talking about insurance claim. The whole, there was no insurance and the whole stock got lost. So how to make an accounting entry in the books of accounts? So one way could be, of course, reduce it from the cost of goods sold. In case it is raw material or WIP, or reduce it from the change in inventory when it is a finished goods, or a raw material is cost of goods sold, WIP and finished goods change in inventory. So you reduce from that, disclose that on the in the notes where you say my opening stock, add addition, less loss due to theft or fire than closing stock. You won't be making an adjustment in the ledger account in the purchase. The purchase would be remaining same. This is again my personal view. This is not the view of the ASB or VSB. And then of course the inventory would be reduced. And another way could be where there is no specific entry, only the inventory is reduced, giving the effect. The effect of both would be that my gross profit or net profit is reduced to the extent of the loss. However, how to disclose that in the financial statements or account for it is important. Now here I would like to add, After Ind AS 2, if I talk where the entities are following Ind AS 2, they will have no option for the second bullet, this one. No specific entry reduce inventory. Why? Because para 34 says that you have to account for any loss of inventory in the books. So if I have to account for, then what I'll have to do, I have to reduce, I have to disclose that in my statement of profit loss, reducing the change in inventory or reducing from the cost of goods. In case of non-Ind AS, we still have both the options. In the first case, there would be a line item separate. We'll reduce from the cost of goods sold or change in inventory and say loss due to theft, loss due to fire. So changing heads from debit to debit side, crediting the cost of goods sold and debting my loss on in inventory due to fire or theft. So it would be like that. And in case there is an insurance claim, of course, you have to recognize the insurance claim to the extent it is receivable, as per my other accounting standards. To that extent, you have to do that. So this is one of the very, very important points. Another one, which is faced by various entities who are into, I would say, who has certain search or surveys. So in that case, what to do? There is an excess stock which is declared by the company, the entity. So how to account for that? Now again, please take care. There is an amendment again in Schedule 3 and CARO both, that if there is an undisclosed income or an asset which has been declared by the company during that search or survey, then later on you have to account for it. How you have accounted, or if you have not accounted, you have to disclose that into the notes of accounts, and auditor will have to report thereof in his CARO. So how to account for that? Again, here I would say you declare the income at one side and have an unaccounted purchase account or whatever title you want. And when you debit the unaccounted purchase account, the stock would increase. The ultimate effect would be there. The ultimate, I'm not going into the taxation aspects under which section it would be 69 or 69A or 60. No, of course, 68 is not applicable, but I'm telling that, yes, under which section you have made the taxes and what are the tax rates, that is not the point of discussion today. But yes, unaccounted purchase, you have to debit and declare income, other income or income surrendered during the survey, unaccounted sales, whatever you want to say, and then increase your stock, right? As I was saying, Schedule 3, undisclosed income, details of any transaction not recorded in books of accounts that has been surrendered or disclosed as income, and also state whether previously unrecorded income and related assets have been properly recorded in the books of accounts during the year or not. So now there is a requirement in Schedule 3 to disclose the specific this transaction, right? So these are all accounting things which have to be. If I try and compare the three standards, I would say the accounting standard, the Ind AS, the ICDS. One of the things which everyone, a chartered accountant in practice or even in the industry, they know that as regarding the duties and taxes, the AS and Ind AS, they say that have to be exclusive method, that you don't have to include the inventories with the duties and taxes. But ICDS, they say it has to be inclusive. And therefore, we know that there is section 145A and there is a disclosure in TCD. There is a tax audit guidance note out there where they have given the example, the institute has given that example, that the net effect is nil. But as per the standard, they say exclusive method, it is to be there for the AS as well as Ind AS. For ICDS, it is inclusive. As regarding machinery spares, again, there would be a change. There would be a change in the accounting. Change in the accounting as well as in the income tax, I would say, through the ICDS. If this AS2 and Ind AS2, they have to be read along with the property, plant and equipment, that is AS10 or Ind AS16. They say if that spare is meeting the criteria of PPE, then you have to recognize it. The old one you have to de-recognize, and the new one you have to recognize. So if it is expected to be in a practical way, if it is expected to be used for more than 12 months, then it meets the criteria. Other things, of course, complied of. Then it would be meeting the criteria. Then it has to be taken as PPE and not as inventory. But ICDS is taking the old AS10 issued by ICI, and ICDS says that if that spare can be used only in connection with a tangible asset, fixed asset, and their use is expected to be irregular, then only FA, otherwise it would be inventory. So there could be a case where there are spares which are being used regularly, which are having a life of more than 12 months, but it is irregular that after 13 months, 15 months, it has to be replaced, giving no extra benefit. In that case, in the books of accounts, as per the accounting, you have to de-recognize and recognize, because now literally I would say Ind AS 16 and AS 10 both are at par, PPE, both are at par. So you'll have to account for in the books of accounts, because now AS 10 is even applicable for non-companies. So proprietorship partnerships also, it is applicable, the PPE. The only problem is that these proprietorship partnership LLPs, they don't comply with AS 10 per se, because the disclosure is not according to the gross block, depreciation block, net block. The assets are not depreciated over the useful life and all other things. So normally in the tax audit report, we do qualify that the entity is not complying with the AS10 out there. Right, so that qualification we give, and because we depreciate there not over the useful life, but we depreciate over the WDV method given by the income tax department. But in that case, for that space, again, I'm saying which is an inventory as per ICDS, but a PPE as per AS. So there again, that adjustment would be required in the computation, right? In case of a dissolution of a partnership firm, AOP, BOI, there is no specific provision under the AS or the Ind AS for the inventories. But ICDS says that in case this partnership AOP or BOI, if they are dissolved, notwithstanding whether that after that dissolution that proprietorship is continuing with the business, the assets are to be valued at net realizable value. So this is an exception which is given in the case of ICDS. So again, in accounting, you cannot do that, but in ICDS, you will have to take care of that. Take care of that in the case of dissolution, right? Fair value, if I say AS as well as Ind AS, they don't say that it has to be valued at fair value. In AS, it is not defined, but in Ind AS, it is though defined, and for the purpose of this commodity broker traders, which we say RTS, and a hint has been given in both in AS as well as Ind AS, that in this case they value at the net realizable value, at the fair value. So in that case, when it is at fair value, the Ind AS says so. So they say it is out of the scope of the Ind AS, but then fair value has been defined accordingly. In ICDS, this fair value is not defined. Once the inventory has been recognized, is valued, accounted and valued in the books of account, and it is carried forward to the next year. And suppose it is valued at, when we say cost and net realizable value, and due to the market circumstances, the net realizable value is less. Suppose my cost was 100 and my NRV was 80 rupees, then I'll have to provide for 80 rupees. Value the inventory at 80 rupees. The AS says, okay, value at 80 rupees. ICDS also says at 80 rupees, and the opening would be again 80 in the next year. But Ind AS says that in case in the next year, that inventory is unsold and it remains thereafter in the next year and also. Then if that NRV is increased from 80 to 120, say, they say you have to write it down, increase that write down to the extent of it was written down. So you have to bring it back to 100 rupees, which is there in Ind AS, but not in AS or ICDS. So in AS and ICDS, if you say it has been written down to NRV, that becomes the opening stock. But in the Ind AS, you have to increase it to the extent it was written down. Right. Another point out there would be subsequent recognition of the cost of carrying amount on inventories, where it says that subsequently, whenever the revenue is recognized for sale of that inventory, you have to recognize that as an expense. And also this para 34, the para 34 is one of the major difference between Ind AS 2 and AS 2. Though the basic things would be same, but it clearly provides, even in the case of loss of inventory subsequently, which we were talking about in last slide, which says that in the case of loss of inventory, that prior 34 says that you have to provide for that as an expense. Though automatically it would be there as per my general accounting practice because the stock is not there, so you'll reduce that. But para 34 says that in that case also you have to provide for that as an expense. So I have to create that line item. This is again my personal thought, I would say. So in that case, in case of loss of an inventory, subsequently after recognizing it at the year-end reporting period, then if there is a loss, you should have that separate line item out. But ICDS and AS doesn't provide, so that thing is covered under Ind AS para 34, I would say. Disclosure requirements, if I say AS, Ind AS and ICDS. AS and ICDS, they are virtually same. That accounting policy is adopted for measuring inventories, including the cost formula, then total carrying amount of inventories and the classification. ICDS also says same, but it adds another requirement that in case a standard costing is used as a measurement of cost, then you have to give a confirmation line of confirmation of the fact that standard cost approximates the actual cost if you're using the standard cost. So that is in the ICDS. Right. Now, again, if I talk about ICDS, the carrying amount of inventory, suppose that is given in the balance sheet, and classification, again, we had one of the earlier first slides which talks about classification. So classification we have to do accordingly. Ind AS, apart from, of course, the same disclosure which is there for accounting policies, cost formula use, the carrying amount of inventories, the classification, it includes others like carrying amount of inventories carried at fair value less cost to sell, that is NRV. What are their carrying amounts? Inventories which are recognized as an expense as per para 34. Reversal of any write down that is recognized as a reduction in inventories as an expense as per 34. Circumstances or even that led to the reversal of write down. What were the circumstances of a write down as per para 34, the circumstances, and the carrying amount of inventories pledged as securities for liabilities. Now, this requirement of carrying amount of inventories pledged as security for liabilities is not there anywhere else. So here it is for the Ind AS compliant companies, it would be there. So these are the comparative disclosures for various entities, right? I suppose this was I basically wanted to share basically on the accounts and the accounting aspects. The queries, if any, that we will try and take it later. So I'll stop my presentation out here and request TV Balasubramanian to please take it forward from here.
Thank you, Ji. Hope I'm audible.
Yes.
Yeah, good afternoon to everyone. I will straight on take it from where Pramod Ji stopped on the accounting of inventory in various aspects of it. Now, one key thing which we need to understand is that the accounting requirements for inventory has certain valuation requirements which may not necessarily be completely in line with the valuation requirements under the valuation standards. So these are for different purposes, and purpose determines the method of valuation is one of the things which is there in the valuation standards itself. And essentially what the accounting standards are prescribing is the requirement for valuation for the purpose purpose of accounting treatment. But there is a thin line of difference between the book value and the fair value of inventory, which we need to very clearly understand. Book values are generally based on historical costs. Of course, there could be an impact coming because of NRV, which we will also look at how it differs from fair value. Typically, the book values are expected to be lower than the fair values. Typically, there could be again cases where it is different. We will see that. So this is one of the key things we need to understand. So essentially, the fair value determination expects certain other factors to be considered. So we can broadly look at it as three types of values which are coming up. Or one is the book cost of the inventory, which is the original cost of purchase or the purchase cost plus the added cost for bringing the inventory to its current position. So that could be one measure. The second measure could be the net realizable value, where essentially we are looking at the amount which can be realized by sale of that item, less the costs which are there to complete, etc., to arrive at the current position. The fair value lies somewhere in between. Now, what happens is in the cost method, essentially only the costs which have been incurred have been considered. No profit element or margin element has been considered. Now, when we look at the net realizable value, which is the other extreme where we are taking from the sale value, we are only deducting the cost to be incurred. So essentially, we are recognizing even the margin element which would be on work to be done in the future. A fair value essentially but deals with something in between, which is a fair value which can be ascribed to the item as of today, considering the costs which have been incurred and the profit element which would have, or the margin elements which would be appropriate for the stage it has reached today. Of course, adjusting for current market costs also. So to this extent, fair value could lie somewhere in between in general. That is something we need to have back of our mind clarity on these three different aspects of the same inventory which could come up. Now, generally, when does the fair valuation under the valuation standard become more important? The most often seen cases under the IBC code now. So when they are looking at valuing inventory as part of the assets, either during say ARP or during liquidation, that is when one major area of requirement comes up for fair valuing the inventory. Of course, as Pramodji pointed out, there could be transaction times of transactions. Also, this could become important if it is materially large and the best way to keep it in mind is always think of inventory as gold. Now, even in a transaction, obviously, you're not going to transfer it at cost. You're going to transfer it today's market value. At any situation, you're going to always relook at it at today's values is the key to something like that, which is also easy to transact and also has varying value on a daily basis. So always keep that as a thing in your mind to think of doing this. So with gold as an example, let me also talk about the three aspects of the valuation. The first one is cost. Let's suppose the jeweler had bought the gold a few weeks back. His cost would be what is the price he had paid at that point of time, right? And let's suppose the jewelry has, the gold has been converted into some jewelry today. There would also be the additional cost of work done on that. So that will be the cost. Now look at it as an NRV. Let's suppose between the 3 weeks back when he bought the gold and today, there has been a downward slide in the gold value. Obviously, the jewelry which you have created is going to be sold for less. However, there is a sale price for the jewelry which is higher than the sale price of gold per se. Typically, that would be the case. So it will be determined by what is the sale price which can be realized on selling the jewelry today, less any cost to sell, etc. So that would be the NRV. Whereas a fair value as of today would be, let's look at it that the jewelry was half made, not completed, it was halfway done. Then it will be based on today's market price of gold, but it will be adjusted for the profit element and the work value on it pro rata only, including the margin, because the work is not completed on the jewelry. So this could give you an idea of how the three aspects of the values could vary based on the circumstance for which it is being looked at, and which of the three we are going to use, cost or NRV or fair value. Now, where this has most relevance in inventory valuation, especially in and it could have significant differences. One is gold and jewelry, other jewelry items, or precious metal and precious stones. One big area where there could be significant differences because the values could fluctuate significantly. Second is real estate assets, where also the inventory could be, the cost could be old because the inventory has been there for long, and then the market prices could significantly vary over a period. So that is another area where there could be significant differences which can come up. So these are two areas where there could be significant differences. Financial instruments, of course, can also be another area where if financial instruments are held as inventory, there could be significant differences which can come up with that. So these are some things which we need to bear in mind. Now, the approach under the accounting treatment is cost, net realizable value, and then you see which is more appropriate in the given scenario, etc. That is the approach. Whereas when it comes to fair valuation, the approach itself changes completely. The approach is either you use one of the three basic approaches which have been prescribed under the valuation standards: the cost model, the market value model, or the income approach. So one of the three approaches you will have to take up, and all three may have relevance in different scenarios. Then the second thing you need to also consider is how you are going to determine the current value of the inventory. Now, the current value of inventory could be driven by two different aspects. One is, what is the current stage of the inventory's position in its life cycle? The second is, what are the current market prices vis-a-vis what happened when it was originally bought, etc. So these two could have significant influence on the fair value you are determining. So by and large, there are two broad approaches which are looked at. We will look at it more in detail just now. So basically, before that, I just wanted to reiterate again the accounting aspects. We go by the book value, which is, let's say, if it is on historical cost, it does not consider, it consider the cost of moving up the value chain, but it does not consider the value created in moving up in the value chain. So this is something which is critical to understand. Similarly, when we are using the NRV method, the NRV method does not consider the adjustment which is required for value yet to be created. Cost yet to be spent is considered, but not the value yet to be created. So this is one key thing I wanted to reiterate before we move on to the valuation, fair valuation models under the inventory, for inventory. So coming to this thing, broadly the two methods which can be used are, one is the top-down method or the bottom-up method. So what are these top-down method and bottom-up method? Let's look at it in more detail. So essentially the top-down method starts with the selling value. Today, if the item of inventory in a completed finished stage, what it can be sold for, what is the current market price. Based on that, then you deduct what is the activities which are yet to be handled on that, and what is the cost related to that. Not only the cost, what is the fair margin to be allocated to such value to be created in future, adjust that and arrive at today's value. So this is the top-down approach where you start from the selling price side and come down to current status. The bottom-up method is to start from the book value of the inventory and adjust it for the processes which have been already done, and also allocating some fair value margin for the processes which have been carried out in the item to today's position of the item. Now, if the WAP is in 50% completed stage from all action perspective, theoretically 50% of the margin should also be considered. Theoretically, let's assume for a simplicity sake we are looking at like that. So in a cost model, what will happen is if 100 rupees is the purchase cost of the material, 50 rupees is the work done on that, cost of work done, labor and power, etc. 150 will be the carrying value, whereas in a fair value, it will be 150 plus a reasonable margin which can be allocated on the work done till now. So if the final margins are expected to be, say, 10% on the cost, there should be a 10% addition, probably, if it can be evenly taken as a representative application. We can take a 10% margin on this. So this is the bottom-up method where you start from the bottom cost and then arrive at by adding the cost as well as a fair margin on thereon to arrive at this. Now, between these two methods, we have to very clearly understand the ICA valuation standards, which we are all supposed to also adhere to as valuers, very clearly says that the selection of the valuation technique should be focused on what maximizes the use of relevant observable inputs and minimizes unobservable inputs. So the whole approach should be selected based on which method or which valuation technique would have the maximum observable inputs and otherwise. So top-down method can be a preferred method wherever sale prices are well known and we are looking at work in progress or finished goods to be valued. So here the sale price is clearly established and available, and then making adjustments would be much less subject to assumptions as compared to coming from the bottom for that. However, for raw materials, as well as, say, for example, work in progress, which are in early stage, probably the bottom-up approach could be a more preferred thing because readily current prices of these would be available. And that can be used to look at this thing. The assumptions, again, would be limited and minimal. Subjective assumptions will be minimal in this. So essentially, which of these two approaches we are going to use will have to be very carefully chosen and applied on a case-to-case basis. So I think that is very important to keep in mind in doing this. So this typically is a concern which always arises. So that is why it has been also specifically dealt with in the concept paper. When to use which method is always something which has a concern for valuer. So this gives good guidance as to which way to approach towards that. So again, to reiterate what was stated about the this thing, NRV and cost, somewhere in between generally would be the fair value. So valuation always looks at the fair value unless it is a statute-driven valuation where you are going to do as per the prescription given in the statute. Now, wherever you are to do a fair value as per the standards, you have to go by the standard which prescribe the three methods: three approaches and the various techniques under that. We have to also follow that for inventory. Now, from a pragmatic and practical perspective, it is divided into two types approaches: the top-down approach and a bottom-up approach, which you can use depending on the scenario. The general approach could be that if you are working on finished goods or late stage WIP, it's much better to work from the top-down approach. These are general, of course, there could be always exceptions. And similarly, when you are coming from the other end where you are looking at raw materials and things like that, you could work from the bottom-up approach. Now, before moving on, I also want to touch upon some interesting cases which can come up. Now, in accounting standard itself, this is one area where there could be this thing. Now, if you take the oil companies, for example, they have huge stocks in their pipelines. These pipeline stocks are like more or less like a dead stock. Now, the Ind AS or AS does not give direct reference as to how it can be dealt with. There are, of course, internationally various other standards where there are some specific prescriptions for such dead stocks, because at any point of time, this amount of stock has to be kept in the pipeline for it to be actually put to use. Without the pipeline being full, material cannot move. So this is the crux of the issue. So there are various methods by which they account for this. Some of them account for this dead stock at the original cost at which it was filled originally, and they keep it like that. Some international practices have this. Now, in a scenario like that, look at it when some transaction is happening or when you have to do a valuation now for a different purpose, say IBC or merger transaction or things like that. The value of this pipeline stock could be significantly high compared especially to the cost at which it is being carried, significantly high. So on a case-to-case basis, there has to be specific application of mind and specific application of thought to the various aspects of inventory, which needs to be looked at. Another area where, of course, it's not typically there, one of the biggest challenges which valuers face in terms of inventory is, where do we get the technical knowledge to do the evaluation for this? It's basically a component or some product which has come from various suppliers to this entity. Now, how are we competent to do a valuation of this? Now, the difference is that as SFAs, even not as SFAs, as CAs, we have been valuing inventory for the purpose of accounting, where again we have been for historically applying cost or NRV models to value or at least to cross-verify the valuation which has been done from time immemorial. I don't think it, so essentially it requires certain amount of inputs being taken from others, say in terms of, for example, the quality of the material which is there, the usability of the material, the technical obsolescence of the material. All this is something where you may need to take inputs, but the financial portion of that ultimately falls onto the SFA valuer to value, because it's part of the current assets. This is something which I wanted to also touch upon, because this is something which has been always a bone of contention as to who's to value it or whether we have the competence to value it. Now, when we look at from an Ind AS perspective, there is a Ind AS 113, which is a fair valuation measurement standards. Very clearly, they give priority to market-based input for valuation. That is the hierarchically the most highest level of this thing from an Ind AS 113 perspective. Whereas in inventory valuation, it may not always be possible to go by the market approach, may not be always, right? So, and we need to be necessarily aware of the fact, and then we need to be able to apply the various other possible methods which we can use. Because most of the time what happens is the material we deal with may not be exactly comparable products which has a ready market unless we are dealing with some commodities, etc. So the market approach per se, getting a direct quote from the market may not readily be available. We may have to make adjustments and work. So that is why generally is one area which may not readily apply to many of these. Of course, when it is a commoditized product or if it is a financial instrument which is being held as inventory, there and all it can probably come in. There could be a market approach which would readily be available and be usable very clearly. So now let's look at these methods in a little more closer this thing. One, steps in top-down method. What are the steps? So as I was saying, we start from the top. So first is estimating the sale price. Now, the sale price itself should reflect the market price of the finished goods as of now. So, assuming that the material is a completed finished goods as of now, what will be the sale price it can fetch in the market? So that should be the basis for estimating the selling price. Then there is a need to determine what are the costs required to complete the sale. Maybe it will require moving it to some place for sale. Maybe it will require some additional work to be done on the material to complete it, which could involve labor, material. It could involve other inputs like power, etc. So that is another thing which needs to be considered. There could be selling margins which will have to be paid to the seller. There could be commissions involved. There could be distribution, logistics costs involved. So these have to be considered, and that is something which will have to be adjusted to the selling price. Now, is it only the cost which will get adjusted? It is not adequate. Now, the third step is to identify the profit or margin element which needs to be allocated for the stage
Balu,
of
sir?
the. Yeah.
Do you have a presentation? Actually, members are saying if you have a presentation, you can share.
No, actually, as it was a VCM, I didn't get
No
a
issues, sir.
Yeah.
No
Sorry.
issues, sir. Just wanted to check.
I could have done that.
Okay, sir.
Actually, it could have been this thing. I thought it was going to be more interactive. I kept it. So the third step would be to identify the margin element on the cost to be incurred and the cost already incurred. Divide the profits to the two or the margins to the two for the stage which has been completed till now and for the stage which is yet to be done, and accordingly adjust that also from the selling price. So essentially, the big difference between NRV and this thing is this considers the profit element or the margin element also to be adjusted, whether it is from the top-down approach or from the bottom-up approach. So these are the three steps in a top-down approach. In the bottom-up approach, similarly, it is a three-step process, but coming from the bottom. Take the cost which were originally incurred on the inventory, add to it all the costs which have been incurred on it to bring it to the current stage, and also add the appropriate share of margins for the efforts which have been already put in. So these are the estimates which are required from the bottom up approach to reach here. Now, from a valuation perspective, where are the areas where there could be difficulties which are faced from a practical perspective? So like I was mentioning, one of the biggest areas where practical difficulties are faced is where these inventories have to be valued and you don't know about their quality, their current status of usability, and then their obsolescence, etc. For those as I was saying, the best approach would be to take some technical inputs, then adjust for that and move forward to the valuation on a financial front. So that is the probable way of approaching it in a practical scenario. The second area is where there are intangible items which are under development and they have to be valued. This again poses a big challenge because understanding the intangible and understanding the status of that and the future work which is required on that is much more intricate and requires a lot of thought and time efforts on it. In most of these, it is probably, if it is an intangible which is being developed, the bottom-up approach may be a more appropriate thing because there may not be readily available market information on the selling prices. So best would be to look at it from a bottom-up approach as to the costs which are being incurred and what kind of valuation it can fetch as a completed asset, as an inventory to sell, and then adjust the margins for that. So this could be a more appropriate way of dealing with it, coming from a perspective of intangible being valued. But then the next question is, how do we adjust for the costs, including specifically the interest cost, the value of inventory, in the value of inventory, and then you will have storage cost. So all that, how do you adjust for it? Now here you will have to be very, very careful in how you are going about it. Now if you are, that's why we were talking about profit or margin allocation being done. It depends on how you are allocating the margin. If the margins are being allocated on the basis of EBITDA, then automatically the interest component, etc., is already considered there. So you need not separately add them as a part of your costs in arriving at inventory valuation for that item, because in the margin itself you are applying EBITDA as the basis for your margin. So that covers this part in a way. So you will have to decide how exactly you are going to approach on a case-to-case basis. Now, these are some thoughts from a valuation perspective. I think we could take questions where we can look at what concerns are there, and then we can look at specifically discussing more on that. Now, I request all your questions to be put up so that we can take it up. And I'm sure we have a good set of people available to give their inputs also on the questions. Sarika ji, I think if we can take on questions, it will be a good start from here.
So the first question is, usually in cases with turnover up to rupees 5 crore, we value inventories by applying gross profit rate because of non-availability of stock records. Is this right methodology?
I think Pramod ji would be ideal to give a response on this.
What is the question, sir?
Usually in cases... Usually in cases with turnover up to rupees 5 crore, we have value inventories by applying gross profit rate because of non-availability of stock records. Is this right methodology?
No, it is not. Yes. No, this is not the right methodology because AS does not allow so. It is clearly that irrespective of turnover, whether it is 2 crore, 5 crore, whatever it is, and if the assessee is not having a stock records, kindly you qualify it accordingly. The qualification is to be done accordingly. They have to have the stock records.
Sales of goods completed in, say, financial year 21-22 for rupees 1 lakh. Goods dispatched, sales booked in the books. As per contract, seller was eligible for enhanced amount in case the cost of input, raw material is determined at higher value as compared to the project cost at the point of settling initial sale price of rupees 1 lakh. Incremental value is determined in financial year 22-23, say in the amount of rupees 25,000, and supplementary invoice is raised. This is a very subjective question actually. My query is whether rupees 25,000 would be accounted in financial year 21-22. If yes, in what manner? It's not like we can...
Case specific.
Case specific.
I don't understand
exactly.
The whole detail.
Valuation in case of coal industry in India, kindly guide.
TV sir.
Balu sir.
Oh, sorry. What was that query?
Valuation in case of coal industry in India, kindly guide.
So, coal industry per se, from the coal suppliers, I have never done valuation or I have not looked at the valuation, but coal users, large coal users, yes, I have seen how it is gone about. The same process is adopted. I would presume on the coal extraction side, the extractive industry guidelines would to an extent be used, but let me not get onto it because I have not practically seen it. From the user side, it is clearly the same basis which is used. Like Pramodji was mentioning, it is either the weighted average cost or the first in first out cost which is used. Generally, what they will in many cases do is use lots also in the FIFO model, so their pricing cost allocation will also be on FIFO model accordingly. That's how they do it, and because of these being bulk materials, there could always be some differences in this thing. So every lot when they are finishing, they will ensure it becomes to zero at that point. So they ensure that the allocation of cost is done accordingly.
Next is, suppose the assessee has not maintained any quantitative details and he deals in GST as well as non-GST items. Do both these details need to be given 3CD?
Oh, the details of what here, if you do a tax audit, a specific clause that requires is the quantitative details, and that the assessee has to provide. If the assessee is not providing it, then as an auditor, you'll have to qualify. You don't have to prepare the books, the assessee has to prepare. So you have to take the call accordingly.
How can one value brand value of established business and account for it in the books of accounts?
The valuation, Balu sir would be telling, valuation can be done, but self-generated brands cannot be accounted for in the books of accounts. The AS and Ind AS, they both don't allow it. Let us be very, very clear. Valuation can be done by Balu sir, but you cannot account for in the book self-generated brands.
Absolutely.
Next, if the valuation of inventory is wrongly determined, even after proper care and caution in the financial statements, to what extent is the auditor responsible?
Auditor is responsible if he is negligent. I think it all boils down to that ultimately. We have to understand our responsibility as auditors and perform. We need to be able to show that we had done due diligence and care in our undertaking the audit, and if there is something grossly wrong and it falls on us, if the documents cannot show otherwise, I think you are in trouble. That's simple.
if there were provisional figures in the statement submitted to bank, then still we need to disclose variation as it was prepared for MIS purpose.
The crux of the Schedule 3, sir, I will go ahead and reply to this, sir. My views, maybe you can add to that. The crux of the Schedule 3 requirement to report on the variations, and also by the auditor to report on variations with regard to the stock statements given to bank is, if the stock statements are given for DP purposes, then the DP is being calculated based on that. So essentially, the purpose of the whole thing is to ensure that there is no DP violation by giving fraudulent or false information. So what really needs to be seen is the application of materiality here. We'll have to specifically see whether by using a MIS number which is different from the final actual number which is concluded, there is no DP violation. If there is no DP violation, I think it is more an estimation which is being presented. For example, some companies do understate the value in the stock statements they give because they give based on MS, because the final accounts might not be done. Probably some overhead allocation to work in progress would not have been done. All that will be there. Obviously, there will be some differences between the two. So as long as it is not material to leading to a DP violation, I think we are in the right track. So that is the key to the reporting there, which we need to look at as I see it. Pramodji can also share any thoughts on that.
Very rightly said, Valu sir. The only thing is that the queries here wants to say that it is not the stock statements which have been submitted to the banker for the DP purposes. They say for certain other purposes, renewals or other things, they have submitted the provisional financial statements, and there the stock value is different. That is not covered under that requirement of Schedule 3 though. But here again, the auditor should in that case surely verify the same. And in case those are being certified through my SRS 4410, the compilation engagement, then the role of the auditor to that, I would say the chartered accountant comes to that extent. But of course, what was the basis for giving the statement? That should again be verified during the audit process.
Yes, sir. Whether disclaimer protects auditor under this situation with regard to the valuation of inventories?
A disclaimer of what? The only thing is what disclaimer of what? A disclaimer of the true and fair view of the financial statements, or you say disclaimer for the valuation of inventories, or what? It would depend upon what is the fact. And accordingly, you have to see that whether it would be a qualification, adverse, or disclaimer. So the auditing principles, all that you have to see. So you have to see that facts accordingly.
I think continuing on what he said, earlier on itself, Pramodji was mentioning that you cannot state the values have been as certified by the management is all out. That is not possible. Yes. So if it is a disclaimer, in that kind of a disclaimer, that is not a protection. It is calling for attention and asking for action to be taken on you. I think that's a gross violation of what is expected from us as an auditor. Of course, like he was saying, if it is materially significant, the way we give a qualification or disclaimer in the report is a different issue. That could be a protection. If you are disclaiming in the report, then that's a different issue altogether. But surely the use of phrases like where the inventory is as well certified by the management, all that is pass and it's not acceptable. Frankly.
Next question is for trading stock, how to take net realizable value?
Trading stock also, net realizable value would be my selling price less the cost which it is probable to incur to make that sale. So that is the net realizable value out there thereof. It could be that my selling price has reduced post purchasing of the stock in trade, or my expenditure thereof to make the sale is much higher. So it would depend upon case to case.
Next is, in case of hardware and sanitary trader, is retail method of valuation sufficient?
Again, I don't think so. It would suffice the purpose because there is only, I would say, a single hardware items. But of course, they say that if they are having sanitary and so many other items, it is more of a retail store, not a wholesale. It is a retail store. Then if they can substantiate to that extent, then they can go, otherwise not.
Yeah.
Sarika ma'am,
Yes, sir.
maybe let me have the privilege of taking the subsequent questions with my chairman and
Sure,
the speaker.
sir.
Yeah, I would also get a little more. So
You start with lot two questions, sir.
yeah, I'm looking at the order of questions which you have taken. So next question is, in case of loss due to fire oblique theft, how to adjust the insurance claim?
As discussed, it would depend upon the recoverability of the amount. And then the loss, of course, has to be booked. Only the insurance claim, which is probable to be received, that has to be shown as an income. So according to that, it has to be accounted for. The stock, of course, has to be reduced to the full extent, to that extent.
And to add to that, from the dimension of valuing it for the purpose of lodging the claim or substantiating the claim, etc., it has to be based on cost plus models. It's not based on current market price unless there is a specific insurance arrangement on the particular item. So generally, the industry norm is to have on a cost basis insurance claim model for these. Of course, some specific industries, there could be a current market value based approach to it, in specifically where it is agreed in the insurance. Otherwise, it is on cost basis.
Okay. Next question is, how spares replaced under warranty should be valued in case of aviation industry?
These are spares which are going to be used for replacement in future. So from an accounting treatment, it will go at cost till it is put to use because it's still inventory. Warranty provision is separately made. That's a separate subject. The material which is being carried with us is inventory. So that is a separate subject. So this will get valued at cost or NRV in the normal course. There is a warranty provision which is made for the future liability on account of any claims. So this is from a perspective of inventory which is carried for that purpose. And the moment it's actually put to use, it's getting adjusted either against the provision or to warranty cost where it gets debited at cost. So that's how it is dealt with.
Just to add out here, Balu sir, in case of aviation industry, you have to first see that whether it is being recognized as per it is meeting the conditions of a PPE or not. If it is having a different useful life, then it would not be an inventory in the books of accounts. Absolutely. And again, as per ICDS, as we discussed, as per ICDS, if it is regular, then it would be inventory out there. So that adjustment we need to get.
Okay. Whether an auditor can qualify tax audit report as yield, shortage and excess is not possible to determine. Whether the same to be qualified in independent auditor's report, if yes, then how, as it may affect the valuation in the absence of proper reconciliation.
What you are talking about is yield, etc. Again, it is a tax audit issue out there. But when we are talking about yield not ascertainable, etc., it would be not affecting my true and fair view of the financial statement. It will not be there into the independent auditor's report, or I would say para 3, PCB issue. PCB issued, only then there is an issue. In PCB para 3, it will not be coming because it is not affecting the financial statements per se, because it is just a determination of the yield and the shortage excess. But however, for that clause, 38, 39, whatever the clause is, 34, 38, 39, whatever. There in the para 5 of 3C B, you'll have to give your disclaimer or a qualification out there. If it is form 3CA, then your para number 3 out there. Related to that aspect only, not to the whole financials.
Okay. But I'm not sure about this question number 4 because it says just one liner, this value we'll see on 31st March or 1st April. So not sure this question is incomplete, looks like. If it's talking in continuation of question number 3 or it's a separate question. So I'll go to the next one. Stocks reported to bank at lower side on conservative basis, whether it will attract any undisclosed income.
Not in the normal course, if it is based on some MAS, etc., and for the stock statements for the DP purpose. But if it is not brought into books, then it's a different issue altogether. It could lead to undisclosed income. And probably the previous question, maybe, when we were talking about valuation, looking at the current price, etc., which is the price we should take, 31st March or 1st April? So the typical thing is 31st March, not 1st April.
Here, we were talking about, sir, the question you were saying was about
Stocks reported
stock statements are lower than the actual stocks. Would it lead to undisclosed income?
No. You say undisclosed income, I will not say. First of all, when we are giving to the bankers, one thing has to be very clear, is the quantity telling. There's a difference. When we talk about valuation, we forget about the quantity. Are the quantities telling with the books of accounts or not? If the quantity is in the variation, then you have to have a reason that why a different quantity has been given. And the valuation is then different, whether you are varying it different. In the variation, whether it is plus or minus, you have to give in Schedule 3, whatever is required. And the auditor should have the reason. Of course, when the accounting is there, then you have to give in Schedule 3. But then the auditor will have to have a reason that why the variation is there. Document. And if it is different, then he has to take it accordingly.
Okay. How to value jewelry for purpose of Ind AS?
Typically, today, there are a few jewelers who have also moved on to Ind AS. So, essentially, they are also following the same option. They are either using cost or NRV as it may apply. That is what is currently happening. And cost, they are either using weighted average or FIFO to arrive at, largely FIFO, because that is more reflective of their business trade. This I am talking about those who have moved on to Ind AS and this thing. Of course, there are various methods which are used which are not necessarily in line with AS2 or Ind AS2 by others, but that is not what we are talking about. Clearly,
Balu sir, here, just to add, it would be only in the case of gold jewelry. In case the diamond, it has to be specific identification cost. It may not be first out there. But again, they maintain stock a bit differently, what I feel. So they have that in kilos and the number of pieces. They don't have item wise. I don't know. So according to that, the valuation has to be. But again,
mostly
what you said
they
perfectly
keep like that only. Weight and numbers.
So diamond, etc. It cannot be first in, first out. But gold, of course, they are following.
Okay. How to also value painting that have been purchased 4 years back and now we need to value as per Ind AS?
If it is fair valuation, then it's a different question. Now, if assuming, I will come to that, if it is accounting without any this thing, it's basically cost which will continue unless the NRV has dropped significantly. But for a moment, let's assume there is a fair valuation requirement for the this thing. The largely accepted method is to use comparables. even if there are not direct comparables, they do an adjustment from other comparables to arrive at. That's what is the most preferred method amongst valuers for valuing artwork.
I'll just add out here. First of all, he has to decide whether it is inventory, PP, or investment. So depending upon that, the valuation has to be done. The principles of Indians will go accordingly only.
Okay. If there is an inventory item in books of accounts from past 3/4 years, can we reduce the value on the basis of management representation as clients say that actual value is now lower than the cost? No concrete market price value is available.
Here, as an auditor, you have to look at the consistency, materiality, what the industry is, etc. Let's assume for a moment this is a material item in the overall balance sheet and the P&L, right? Then this may not be by itself acceptable. There has to be more documentation and there has to be more supporting evidence to even downward value it. Both ways, see, because the standard is clear. Conservatism is not acceptable beyond a point also. So necessarily it has to be at true and fair, which is neither lower nor higher. So if it is materially significant, just a management representation would not be adequate. It's the view we need to come to.
Okay. Can the finished inventory in case of real estate be valued at circle rate as declared by the government?
This again depends on the purpose. Like he said, first of all, we need to decide which Ind AS it goes under. Keeping that aside, from a valuation perspective, there are two sides to it. Yes, you can use valuation circle rates to do it if it is for certain purposes. But it is also a well-known this thing that many a times the sales happen higher than the circle rates. So probably you need to also consider the comparable transactions which have happened in that period, in that area, as also another pointer than just the guideline value which is available. Both can be looked at.
Okay. TV sir, this is specifically for you. The question is, TV sir mentioned in the manner of valuation and advised to add the cost of the process according to percentage completion. Will estimation not affect the correctness of valuation?
Theoretically, theoretically every estimation can have a room for error, right? The way you have to plan the estimation is to ensure that your room for error is limited. That is why, in fact, one of the key things you determine is whether you are going to use the top-down approach or bottom-up approach, depending on what is more appropriate, where you will use less subject to assumptions. That is the given driving force behind this method of valuing itself. But estimation, yes, is required. So if it is material, you need to put more efforts to ensure you are using the right matrix for estimating.
Okay. Next question is, can a private limited company change the valuation method of inventory every year? That is to say, from top-down approach of valuation to bottom-up method of valuation, depending upon the profitability. Or should it follow any consistent method?
So first of all, from an accounting perspective, both these methods don't apply. These come into play only when you have to determine a fair value, say for IBC purpose, etc. So from an accounting perspective, it's very clear you need to go by specific identification or weighted average method or FIFO. So these are given methods which are permitted under the standard. Any change in these will have to have a fair basis behind it. And if it is being done at the whim and fancy for every year, I think it itself could lead to issues around that.
No, but AS also doesn't allow it,
Correct.
for change in an accounting policy, you should have some very basis about it, and then if it is a change in accounting policy, the effect thereof on the profits, everything as per India's 1 as well as AS1 and read with AS4 5 as per AS5, then you cannot change an accounting policy per se like that. So you have to comply with AS5 all along.
Okay, in continuation, this first one only, the question is, please give example of practical experience. So if any experiences of yours which could...
No, normally, if I talk about the role of auditor here needs to be strengthened. Please understand this, that an auditor, this is the main issue I would say we all chartered accountants should take care of, that it is not that whatever the assessee wants, we do according to that. So whatever is the actual law, that we have to see and we have to put our foot down. What is the law? Do accordingly. If it is not in compliance with the accounting standards, or the valuation standards, then we have to give our qualification and observation. We cannot just say what the assessee wants, we do according to that. Unless that is properly documented and in compliance with the AS, say strictly no.
Okay. Can the finished inventory in case of real estate be valued at circle rate? So I think this question we've already dealt with. So I would go to the next one. Raw material cost has gone down as on 31st March 2022. However, company has not reduced its product market price. What to do? Whether valuation of finished goods to be reduced?
See, raw material costs have gone down, whereas I'm just trying to rephrase the whatever has been stated. So raw material prices have gone down, whereas my finished goods are valued considering the raw material cost which has gone into it at a higher price, right? But at the same time, the selling prices have not been reduced by the company. So long as far as the index goes, so long as the NRV is going to be higher than the cost, we can continue to carry at the cost. There is no need to automatically reduce this. This typically happens from period to period in industries where steel or things like that are used as input. It regularly happens. So long as the NRV gap is there, yes, we can continue to carry it.
Okay.
No, I fully agree with I fully agree with Balu sir.
Yeah, Pramodji, you're saying something.
Yeah, I fully agree with Balu sir here that despite of reduction in the raw material cost, whatever the cost has gone into, that is not changed. That has not changed. So my cost is not varying. My NRV is also remaining same. My future raw material cost may go down. So finished goods, nothing. Raw material, yes, there would be impact in the raw material cost. Raw material valuation, if it is outstanding, they are having raw material as at the year end. Then the raw material valuation could be there. Balu sir, raw material valuation would differ if my cost has gone down. So the NRV in that case of the raw material, just your comments on that, please.
Actually, there also the practice is that if the raw material is proposed to be used only in manufacture and sale, as long as the NRV of the final sale product less all costs to do will cover my raw material costs, no adjustment is made, sir. Only if two reasons. Only if the future sale prices are expected to go down because of this, because some industries have that. Whenever the material cost goes down, the output costs go down and vice versa. So in such cases, they will make adjustment. Otherwise, if it will be covered anyway, they won't adjust.
Okay. Dead stock means not usable stocks. Then how can stock lying in pipeline can be treated as dead stock? Secondly, in general, stock is valued at FIFO method. In that case, stock is not valued at historical cost. Rather, value of such stock is changing regularly. Please give your valuable opinion in this respect.
Yeah. So actually, okay, here the term dead stock is used in the oil industry or other industries where they use pipelines extensively for transport of material. And like I mentioned, our AS or Ind AS 2 has not dealt with this, so it's not giving you an option for this. But internationally, there are countries where an option is available to account for it at the original price at which it was filled. So that is why they call it as a dead stock, because it's more or less to be kept there. Of course, the actual material changes. As you pump, what happens is the old material goes off and the new material is sitting. But at any point of time, a given amount of material is constantly kept there, which cannot be sold. So that is why they call it as dead stock. And there are countries where they value it at a very old original price at which it was done. And in the oil industry, as we can see, after 10 years, 15 years, the costs have significantly changed, and it has no relevance to that. So in such cases, when you are looking at fair value today, it will be significantly different. So it is not permitted under Ind AS 2. So we are really not looking at in our books for that kind of stuff.
Okay. Please explain how in automobile industry the inventories are valued.
If it is vehicles, it is specific identification method. From the time it leaves the manufacturer, then in the dealer, distributor and all, it is at specific identification, because each vehicle has an identified cost to it. At the manufacturer's location, they could use FIFO or weighted average, whichever works for them very well. All the spares generally are on a overall either FIFO or weighted average method.
Okay. The last question which I have it on screen is valuation of inventories of oil companies, especially when they talk of inventory losses. What does it mean and how do they recover this?
Come again, what is the question again?
Valuation of inventories of oil companies, especially when they talk of inventory losses. What does it mean and how do they recover this?
Okay, I'm not very clear as to what he is meaning by inventory losses here. So that is something I'm not able to.
No, can
Maybe-
we ask them to
No, just here one point I'd like to add out
They
here.
talk about
Inventory losses in the oil industry is the evaporation.
correct,
Evaporation it is.
losses.
So
right.
So when that is an evaporation, that is extinguished. So how they recover it? It is through the cost of the remaining inventory thereof. They have an expected loss due to evaporation and the transmission losses. So it is that loss percent, which various industries have, not only oil industry. There are various such industries.
Fair enough. I think that puts clarity to it.
Yes, sir.
Over question.
Yeah, the questions I have taken up all the 1, 2, 3 part which was shared over.
Great.
The questions. So
I think most of the questions have been covered. If at all any questions are unanswered, we have received it late, or anybody wants to raise any more things, we will try and compile this, get the answers, and if possible, try and bring out somewhere in the website or booklet the answers for these questions, so that people will get the answers for these questions. I think now we are coming to an end of this session. As expected, it has been a very interactive session. Number of questions came, and I think discussion has also taken place.
More than 4,000.
Yeah, the attendance also is around 4,000 participants. So great response. Perhaps we will definitely encourage us to keep more such sessions on different topics where there's an interplay between accounting and valuation. And definitely in future also, near future also, we'll keep that. I think both these gentlemen who have been presiding over us for last 1.5 hours or so well-deserved vote of thanks, although they are from amongst us only. So I would request Abhay Chajed, Vice Chairman of Accounting Standard Board, to propose a well-deserved vote of thanks and conclude the session for today. Over to you, Abhay.
Thank you so much for giving me this opportunity. Highly respected Central Council member, Chairman of Valuation Standard Board, CA Mangesh Kenreji, and of course our very learned, and I would say speakers today, and Pramod Jainji, the Central Council member, and also the Chairman of the Accounting Standard Board, and TV Bala Subramaniam. And it was indeed, and I think a very interactive session. And like Mangesh mentioned that, having such a huge strength, it itself says that, the topic was very important. And I'm sure members, participating through this webinar would certainly have more questions. And I believe the questions can still be, responded. Of course, we may have interactive sessions coming in the subsequent days or months, or maybe from the office we could compile those issues, and we can try to answer those questions even later. But thank you so much, Pramod Jainji, for covering this very important accounting aspects, and Bala Subramaniam ji for the valuation part, which you have both covered. I think the members would have really benefited with your knowledge of wisdom which you have shared today. And thanks to Mangesh Bhai for sparing his valuable time. And I think the best part about this was this webinar has happened at the right time of the year, and members would really be benefited. And thanks to the office, Sarika Madam and Parmitam Madam, for being there and taking this initiative in the interest of members and having this webinar today. Thank you very much for giving me this opportunity. Thank you.
Thank you, everyone. It's a great session. We'll continue this. Please do write to Office Valuation Standard Board as well as Accounting Standard Board. Again, I appreciate the efforts taken by the office, Sarika ji and Parminder ji, and we'll continue this in future also. Thank you very much all. Thanks a lot.
Thank you, sir. Thank you.
Yes, sir.